Welcome to The Explainer. Today, we're diving right into how to diversify like an absolute pro by mastering the macroeconomy and asset classes. Here's the most expensive myth in investing. Wait for the economy to recover before you invest in stocks. I hear this from beginners constantly, and every time it costs them money.
Because by the time the economy officially recovers, GDP is growing, unemployment is falling, consumer confidence is back, the stock market has already risen 30, 40, sometimes 50% from the bottom. You messed it. You waited for safety, and well, you paid a massive premium for it.
And here's exactly why. The stock market is not the economy. It's a crystal ball that looks 6 to 12 months into the future. Think of it like a train. The stock market is the lead locomotive, pulling everything forward. The economy? Those are just the carriages lagging behind. They represent data like GDP growth, employment reports, and consumer spending. The locomotive always moves first. And in today's explainer, I'm going to show you how to use that fact to your advantage and how to protect your wealth through true diversification that most investors get completely wrong.
Let's actually look at the historical data, because this isn't just theory. Back in March 2009, the S&P 500 hit its absolute bear market bottom. But get this, the U.S. economy didn't officially exit the recession until June 2009. That's 3 full months later. The market was already up massively before economists even confirmed the worst was over. And we saw the exact same thing play out in 2020. The market bottomed out in late March. By June, the economy was still showing terrible contraction numbers, but the stock market, it had already recovered 40%. So the absolute crucial takeaway here is, never ever make investment decisions based on current economic news. The news tells you what happened yesterday. The market is pricing in tomorrow.
Let's look at market movers and how governments actually drive that locomotive.
Okay, understanding these 4 government levers pretty much changes everything. First up, interest rate cuts. When borrowing costs drop, companies expand and people spend money. Stocks typically rise. This is basically the most bullish signal out there. Second, interest rate hikes. This makes borrowing expensive, growth slows down, and money naturally flows out of risky stocks and into safer savings. So that's bearish. Third, quantitative easing, or QE. This is when central banks literally inject cash right into the financial system. It is absolute rocket fuel for the stock market, pushing investors straight into equities. And finally, quantitative tightening, or QT. This drains liquidity, puts downward pressure on stocks, and can absolutely trigger major corrections. When you know which lever the government is pulling, you know exactly where the train is heading.
Moving right along to the 3 buckets of wealth, which is basically a shock-proof framework for your money. Here's the deal. Every single dollar you invest has to have a dedicated purpose. Bucket number 1 is cash. This is your opportunity fund. Bucket number 2 is passive income. We're talking assets generating dividends and reliable yield to give you steady cash flow. And then bucket number 3 is capital gains. These are your growth stocks and momentum plays designed to really multiply your net worth. You absolutely need all 3 of these to survive and, more importantly, thrive across different market cycles.
Now, beginners often think holding cash is a complete waste, especially during a roaring bull market. But holding 20 to 30% in cash isn't foolish at all. It's a highly deliberate, tactical strategy. Think of it as a loaded weapon, just waiting for the perfect target. When market optimism plummets and everyone else is panicking and forced to sell, well, you're the one sitting there with dry powder ready to buy incredible assets at a massive discount. Cash gives you the ultimate superpower in investing: patience.
Next up, let's talk about true asset diversification and why we need to move way beyond just stocks. True diversification requires mixing up entirely different asset classes. Compare stocks and bonds, for example. Stocks give you that high growth potential, sure, but they come with way higher volatility. Bonds, on the other hand, are your stability anchor. They're essentially just loans you make to governments or corporations. And listen, here's the golden rule you absolutely have to memorize. Bond prices move inversely to interest rates. When interest rates rise, existing bond prices fall. And when rates fall, bond prices rise. When stocks hit a major correction, strong bonds often hold steady, giving you that crucial ballast to keep your entire portfolio afloat.
Which brings us to another famous asset class, the ultimate question. Is gold truly a safe haven? The popular narrative out there is that gold is this flawless store of value that just magically goes up whenever the stock market falls. It's a really great story, right? But it's driven heavily by emotion. Let's see what the actual data tells us.
20 years. That is a completely shocking number. If you bought gold at its peak back in 1980, you had to wait 2 full decades until roughly the year 2000 just to break even. And in that exact same 20-year period, the stock market rose roughly 1,000%. So the reality check here is that gold is highly speculative and subject to really long, multi-decade market cycles. It's not some automatic magic shield against inflation, especially when interest rates are low. You've got to dismantle those emotional biases and just look at the hard facts.
Finally, let's look at globalizing your portfolio, the final dimension of true diversification.
Okay, so here are your golden rules for globalizing. First, you want to invest in a minimum of 3 different countries. Second, balance your risk. You got to make stable, developed markets like the US and Singapore with higher growth, higher volatility emerging markets like Vietnam and India. Third, always factor in currency risk. Think about it. If your foreign stock goes up 20%, but that country's currency depreciates by 20% against your home currency, you basically made zero profit. And finally, avoid the home bias trap. Look, it's just human nature to only invest in the companies you drive past every day, but that familiarity gives you a totally false sense of security. You have to break out of your borders.
So I want to end today's explainer by turning the spotlight directly onto you. What is your portfolio's diversification score right now? Take a really hard look at where your money is sitting today. Are all your eggs in one asset class, one sector, just one country? Because if the answer is yes, you aren't investing, you're gambling. Take the frameworks we've broken down today, the train analogy, those government levers, the 3 buckets, and true global diversification, and start fixing the cracks in your financial armor right now. The locomotive is moving. It's time to make sure you're in the right seat. Keep learning, keep diversifying, and we'll see you next time.